Hello, it's Friday the 10th of June. I'm Simon Whitney. Welcome to issue 37 of Travis Smith's Sustainability Insights. This week, we're looking at new rules recently issued in the US and the EU designed to prevent greenwashing in financial markets. It's been clear for some time that regulators are concerned about greenwashing, by which they mean the risk that companies, investors, and asset owners will overstate their sustainability credentials in order to attract capital. But in the last few weeks, the regulatory pressure has significantly increased. Recent announcements from the SEC, the US regulator, and from ESMA, the pan-EU supervisor, will focus the minds of all asset managers, including those running private funds. In the US, proposed new SEC rules for ESG disclosures by investment advisors will buttress an already sharp focus on sustainability claims by the Division of Enforcement. The SEC's proposal, which was published on the 25th of May, is designed to, quote, promote consistent, comparable, reliable, and therefore decision useful information for investors. It will apply to all SEC registered advisors, but also, to a more limited extent, to exempt reporting advisors, a category that includes many European firms with US investors. The change would be to form ADV, the annual filing that investment advisors, including private fund advisors, are required to make, and would require detail on an advisor's use of ESG factors, not themselves defined, as well as disclosure of third-party frameworks that it uses and relationships with related persons who are ESG service providers. In some respects, the SEC's proposals resemble the EU's Sustainable Finance Disclosure Regulation, commonly known as SFDR. The US rules would similarly require firms to categorize their investment products according to whether they integrate ESG factors alongside other non-ESG factors, whether they are, quotes, ESG focused, close quotes, using one or more ESG factors as a significant or main consideration in selecting investments or engaging with portfolio companies, or whether they adopt an ESG impact strategy and they therefore target portfolio investments that drive specific and measurable environmental, social, or governance outcomes. Like the SFDR, these categories determine disclosure requirements, but are not labels. They do not guarantee any particular investment strategy or minimum ESG standards. It will be important, therefore, for the SEC to ensure that investors do not come to regard the categories as if they were labels, a significant problem with the EU rules, already acknowledged by the EU regulators. But although the scope of ESG is not defined in the currently proposed SEC rule, the three product categories do seem clearer and easier to understand than their SFDR equivalents. In fact, despite that similarity, the SEC's proposals for private fund advisors are much less extensive than those which apply under the SFDR. Indeed, they're also less extensive than other SEC proposals, some of which were included in the same release for US registered investment companies and business development companies. The additional information that needs to be provided in the form ADV should help investors to understand the sustainability features of an investment product, and it should help the SEC to enforce its prohibition on misleading investors, but it does not extend to detailed metrics or anything close to EU taxonomy-style reporting. The focus on greenwashing may be acute, but investors have largely been left to define the detail of the required reporting for themselves. Meanwhile, in Europe last week, ESMA issued a wide-ranging supervisory briefing that stressed the need for EU national regulators to look hard at compliance with the SFDR. When taken together with the European Commission's Q&A on the interpretation of SFDR and the taxonomy, and a joint statement by the EU regulators that was also issued last week, the strict approach to application of the new rules is very clear, making an already tough job even harder for affected firms. For example, the European Commission's guidance confirmed that legacy funds, that is, those not made available to investors after the SFDR became effective, are subject to the SFDR's disclosure regulations if they promoted certain sustainability characteristics when they were marketed to investors. In its briefing, ESMA argues that national regulators could reasonably expect an SFDR Article 9 product, that is, one that has sustainable investment as its objective, to disclose the detailed principal adverse impact metrics for all of its underlying investments. That goes further than the law strictly requires. ESMA goes on to give guidance on fund names. Use of the term sustainable in a fund's name seems to be restricted to those making sustainable investments, according to the EU's definition of that term. Moreover, if a firm wants to be categorized as a fund that, quote, promotes environmental or social characteristics, close quote, the lightest category of ESG fund in the SFDR, ESMA confirms that it must have some binding criteria as part of its investment strategy and/or objectives. Although in our view, those criteria need only be binding in the sense that they must be done in the way that they're described. They do not have to mean that certain investments must be excluded from the portfolio. These European clarifications and guidance are, in part, a recognition of the lack of clarity in the original rules, both those that are included in the Level 1 EU directive and in the Level 2 implementing rules developed by the regulators and issued in final form by the Commission in April. But they are also an attempt to course correct. The regulators are concerned that the SFDR categories and self-certification process themselves give rise to a risk of greenwashing, something which they are now working hard to avoid. This ratcheting up of expectations will therefore continue. As if to emphasize the current focus on greenwashing, prosecutors in Germany raided the offices of DWS last week to investigate allegations of greenwashing by the asset manager. And last month, the SEC announced a settlement with BNY Mellon that involved a payment of $1.5 million. These related to public funds, which of course will be the prime focus for enforcement. But private fund managers should take careful note, because despite their mostly institutional and sophisticated investor base, they are not likely to avoid the spotlight for long. Thank you for listening. If you would like more information on this topic, please check out our website, where you can also sign up to receive future editions of these insights, or drop me an email, simon.whitney@travissmith.com.